Hey, JC here with the Agajani Group at Whistle Realty, and we're brokered by EXP. And today I am answering a question that I've received multiple times, and it's come in a couple different forms. From sellers, the kind of idea is, hey, should I just go ahead and wait to put my house on the market? You know, things are crazy right now. Maybe later this summer I'll be a better situation. And when I talk to buyers, the same question is formed like this. Hey, you think we're thinking about waiting for a little while. I feel like we're going to get a better deal. Prices are probably going to come down as a result of all this. So it's really addressing COVID-19 in the real estate market in San Diego County right now. Let's get into it. I've got 7 points for you. These are based in data and not so much my opinion. So I could speak for you anecdotally about the multiple offers I received on a listing of mine in about 4 days with 11 of them just recently. That was this week. Or the 3 buyers I've been working with, all of which have had to contend with other offers themselves in writing them. But like I said, let's go ahead and get into the data that will probably be a little more valuable to you than my opinion and my forecast and even my personal experience working here on the ground in San Diego throughout this process. So first thing is going to be the forecasted economic rebound. So basically what we've got is 3 of the biggest investment houses in the nation, possibly probably the world, calling for a V-shaped curve rebound and not anything else. For the most part, they're calling it to begin moving in the right direction towards the end of the second quarter, possibly the beginning of the third quarter. Clearly, this is a forecast based on data they've got. This is not cold hard facts that you and I have. This is what they think is going to happen. But Goldman Sachs in particular seems to know what's going to happen. Some people think they control what happened, but that's a whole nother conversation. But yeah, these are pretty reliable sources of data. The next thing that we're going to focus on is going to be what I'll call the decoupling of the perceived union of the markets. We've got very different markets. We've got stock markets, bond markets, the housing market, and the economy in general. So what I've got here on this slide is basically a demonstration that just because we go into a recession, which I think most people can assume we are either in or are going to be in, we'll need several months of declining GDP to prove that. So I don't know if we've had enough months yet, but that's neither here nor there. The point is, just because the economy as a whole goes into recession doesn't mean the housing market as a whole falls hard. More importantly, it doesn't mean the housing market here in San Diego County falls hard. You can see here that out of the last 5 recessions, only 2 of them have been coincided with a housing crisis. And the most recent one is the one that most people remember because it was so severe. It was most recent chronologically. It happens to be the fact that it was the housing market that tanked the economy. Of course, financing and poor lending practices, of course, as well. But that's a reason that those 2 were definitely coupled. All these other ones are independent and they act independently. The third point I'll bring up to talk about what we can expect is what I'll call a more measured appreciation of home values over the recent years. Leading up to the great economic recession, we had skyrocketing values. We had people investing and buying based on speculation and poor financing qualification processes as well. Over recent years, we haven't had either one of those. We've had more moderate appreciation, though marked and steady, more moderate. Maybe more extreme here in San Diego. I think our numbers are definitely higher than that over the past several years, but you get the opinion, the idea. These national numbers that we're looking at here paint a different picture of the market that we were looking at 10, 12 years ago. After that, I'm going to look at the ease with which mortgages are given out. you can see from this graph here talking about the Mortgage Credit Availability Index that it was just too easy. It was, and everyone who was of age to buy a home in 2004, 5, 6, 7, and 8 will remember the craziness that was taking place. I was working in the mortgage industry back then, and there was a joke that people use now to describe the time that we experienced back then, which was, it was the mirror test. Is there a person who's alive and will fog a mirror? Well, we'll figure out a way to get them a loan. And that wasn't just originated from the loan officers, that was coming from financial institutions top down with various income documentation and lack thereof styles to get people shoehorned into loans. It wasn't just coming from financial institutions either. You can track that back to a lot of political pressure as well. And that's also a whole nother subject we could get into. But look at the graph. The pendulum swung the other way in a big way after everything melted down. It became extremely difficult to get a mortgage. And while it has loosened up since then, it has not loosened up that much. It is still difficult to get loans. You have to provide all your income documentation. You have to have skin in the game. You have to have some money down unless you're using a VA loan, which is insured by the government. So that is a big reason why we are not in the same position we were back then. Another thing that is huge, and I talk about a lot, is what we call the absorption rate, or what's typically referred to as a month's supply of inventory. As a reminder, I've said this multiple times, but a neutral market, not really a seller's market, not really a buyer's market, is going to have around 6 months supply of inventory. And what that means is if you don't add any new homes to the market, it will take about 6 months to sell down to zero. We have been operating at month supply, far fewer than that for several months and years at this point, and it hasn't changed as of late. This is a national number we're looking at here, 3.1 months supply on a national number. In San Diego County, we are less than 1.5 months supply of inventory, and it's been that way for quite a while. The fact that we have such a low supply of inventory creates a dramatic imbalance between the amount of buyers and the amount of sellers we have on the market, which makes me think that even if a lot of buyers fall out of this market because they lose their jobs as a result of the virus, or they are just afraid to make a move as a result of the virus, or God forbid, they actually fall ill themselves, there's still going to be plenty of demand that's going to outpace the supply we currently have for the future months and possibly even years ahead. The next point I'm going to get into is the equity levels that we're looking at right now. They are significantly higher than we were looking at 12, 15 years ago. People were highly leveraged, and right now they are not. What's more, people have owned their homes for significantly longer. Back then, the average lifespan of home ownership was about 5 years, and then people were selling and moving on. Most people have owned their homes for 10 to 15 years at this point. Because of that, they have more equity. It's also because of a dramatically different philosophy people have now than they did before running up to that Great Recession. It's changed people's mentality entirely. Many folks went through that and got burned financially. People had to file bankruptcy. People had to short sell their homes. People had to foreclose on their homes. And even those that didn't have that, a lot of them just got by the skin of their teeth and realized, wow, I was pretty fortunate. I'm going to look at debt quite differently now. As a result, you've got highly deleveraged as opposed to highly leveraged assets. And that doesn't just go for home equity, it goes for credit card debt, school loans in general. And you can look into those stats yourself. The final point I'm going to point towards is something that you don't hear talked about too much, and that's the affordability index. It's low right now, significantly lower. You wouldn't think this, but it's significantly lower than it was in 2006. The chart here shows that a homeowner would spend roughly 25% of their income on housing expense. Right now, that number is significantly lower, just over 14%, almost 15%. Now, this isn't taking into effect other consumer debt like cars and school and credit cards. It's just talking about housing. And of course, it's addressing the median income and a median price of a home on a national level. Things are going to be a little bit different here in San Diego, where we have a higher cost of living. People are going to carry a little bit higher debt load to get into these homes because of how expensive they are. But the point is clear. We have a lot more affordability and people are being more responsible. So what does all this mean? Nobody knows the future. But if you look at these graphs, these charts, these pieces of data that I went through and what some of the biggest investment houses in the world are projecting, don't think we're going to be coming up on bottom basement bargains for home prices, especially in San Diego, but even on a national level anytime soon. There's probably some exceptions to that. We've witnessed extremely large loan amounts, jumbo and super jumbo. Liquidity has shrunken up on us. So in addition to people that can afford to buy really expensive homes, they've also probably been affected more than the average Joe because so much of their money is tied up in the stock market, which has tanked recently. So we may see some softening in the high and super high end, but in the entry level and the average and even barely above average, I just don't see it. And I would ask someone who thinks that they're going to wait on the sidelines for 6 months, for 3 months, for a year, and get a real deal. What makes you think that? Is it just a gut instinct? Is there some piece of data you can point to? People will lose their jobs. It's already happened. According to the big broker houses, they're going to get them back. Maybe not as many. There's going to be definitely some loss. But we're calling for a rebound. Even without a strong rebound, we still have so much demand and so little supply that we could lose a lot of it and still have the real estate market in San Diego County continue to march in the right direction. So when people ask me if they ought to wait before they put their home on the market, time is now. Inventory is tight, buyers are out in force, interest rates are still at record lows. Take advantage of it. Bird in the hand is worth more than two in the bush. And for those that think that maybe you can wait, get a deal for buying, maybe it'll happen. I'm not convinced of it. So that's where we stand. I remain optimistic that we will get through this as a nation. We will get through this as a county, as a whole with our economy. But more importantly, I think our housing market will be one of the things that leads us out of this economic situation and not one of the things that is collateral damage from it. So I'd love to chat with you more about this. My name's JC and my number is 619-224-9898. Talk to you soon.